In this section, we are going to cover some recommended practices for addressing the risks raised by non-traditional mortgage products. Let's begin by focusing on communications with consumers. When promoting or describing non-traditional mortgage products, institutions should provide consumers with information that is designed to help them make informed decisions when selecting and using these products. Meeting this objective requires appropriate attention to the timing, content, and clarity of information presented to consumers. Thus, institutions should provide consumers with information at a time that will help consumers select products and choose among payment options. For example, institutions should offer clear and balanced mortgage descriptions when a consumer is shopping for a mortgage, such as when the consumer makes an inquiry to the institution about a mortgage product and receives information about non-traditional mortgage products, or when marketing relating to non-traditional mortgage products is provided by the institution to the consumer, not just upon the submission of an application or at consummation. Institutions should strive to focus on information important to consumer decision-making, highlight key information so that it will be noticed, employ a user-friendly and ready navigable format for presenting the information, and use plain language with concrete and realistic examples. Comparative tables and information describing key features of available loan products, including reduced documentation programs, also may be useful for consumers considering the non-traditional mortgage products and other loan features described in this guidance. The provision of such information would serve as an important supplement to the disclosures currently required under TILA and Regulation Z or other federal laws. Please note that institutions may not be able to incorporate all of the practices recommended in this guidance when advertising non-traditional mortgages through certain forms of media, such as radio, TV, or billboards. Nevertheless, institutions should provide clear and balanced information about the risks of these products in all forms of advertising. This note kind of segues us into our next recommended practice regarding promotional materials and product descriptions. Promotional materials and other product descriptions should provide information about the costs, terms, features, and risks of the non-traditional mortgages that can assist consumers in their product selection decisions, including information about payment shock and negative amortization. Borrowers need to know about the concept of payment shock. Institutions should apprise consumers of potential increases in payment obligations for these products, including circumstances in which interest rates or negative amortization reach a contractual limit. For example, product descriptions could state the maximum monthly payment a consumer would be required to pay under a hypothetical loan example once amortizing payments are required and the interest rate and negative amortization caps have been reached. Consumers also should be apprised of other material changes in payment obligations, such as balloon payments. Such information also could describe when structural payment changes will occur, for example, when introductory rates expire or when amortizing payments are required, and what the new payment amount would be or how it would be calculated. As applicable, these descriptions could indicate that a higher payment may be required at other points in time due to factors such as negative amortization or increases in the interest rate index. Finally, borrowers need to be aware of negative amortization. When negative amortization is possible under the terms of a non-traditional mortgage product, consumers should be apprised of the potential for increasing principal balances and decreasing home equity, as well as other potential adverse consequences of negative amortization.